When was the last time you heard anyone talk about TVS Motor's global ambitions with the energy they once commanded? Almost never. There was a time when this Indian motorcycle giant dominated domestic markets and set aggressive expansion targets across Africa and Latin America. TVS executives spoke confidently about capturing emerging markets, building manufacturing plants in Nigeria, and establishing dealer networks from Kenya to Brazil. The momentum felt unstoppable as they rode export growth all the way to international recognition. But momentum only lasts if the markets you're chasing remain stable. Currency crashes wiped out profit margins overnight. Political upheavals forced emergency staff evacuations. Entire dealership networks became worthless assets. The name stayed recognizable in India, but the global influence vanished. So today's question is simple. How did TVS Motor rise this fast internationally? And what pushed their $2 billion export dream into complete collapse? To understand the collapse, you need to understand the empire. TVS Motor wasn't just another motorcycle manufacturer trying their luck in international waters. This was a company with deep roots in Indian manufacturing excellence, founded in 1978 by Venu Srinivasan in Hosur, Tamil Nadu. The company began as a strategic collaboration with Suzuki Motor Corporation, giving them immediate technical credibility that most startups could only dream of. Their first breakthrough came quickly. The 1982 launch of the TVS 50 moped wasn't just successful, it became India's best-selling two-wheeler, establishing the company as a serious player in domestic manufacturing. This wasn't just about moving units, it was about establishing trust in their engineering capabilities and production standards at a time when Made in India didn't carry the weight it does today. By the early 2000s, TVS had leveraged this foundation to become India's third largest motorcycle manufacturer, commanding an impressive 15% market share in one of the world's most competitive two-wheeler markets. For context, this meant selling millions of units annually in a country where motorcycles are not luxury items, but essential transportation for the emerging middle class. What distinguished TVS from many competitors was their manufacturing excellence. While other Indian companies struggled with quality control issues, TVS built a reputation for consistently high standards and cost-effective production. This expertise was not limited to their own products. They became trusted suppliers of components to global automotive companies, further validating their technical capabilities. Perhaps most importantly, this domestic dominance created a financial foundation few expansion-minded companies enjoy. Year after year, TVS delivered consistent profitability in their home market, building a strong balance sheet that would later provide the capital for their international dreams. They were not desperate for new markets. They were financially secure and looking for the next frontier of growth. This combination of technical expertise, manufacturing excellence, market leadership, and financial stability created the perfect platform for expansion. TVS was not gambling on international markets out of desperation. They were pursuing growth from a position of strength. At least that's how it appeared from the outside. By 2010, TVS faced what seemed like the opportunity of a lifetime. Across emerging markets in Africa and Latin America, economic growth was creating a new consumer class, eager for affordable transportation. Motorcycle demand was exploding in countries like Nigeria, Kenya, Argentina, and Brazil, with annual sales growth frequently exceeding 20%. These were not mature markets with established players. These were wide-open opportunities for whoever could establish distribution first. TVS tested international waters carefully at first. Their successful entry into nearby markets like Sri Lanka and Bangladesh proved they could compete outside India. These were not just symbolic victories. They established operational blueprints for adapting products to local conditions, building service networks, and managing cross-border logistics. The numbers quickly became impossible to ignore. TVS saw their international revenue climb from a modest $50 million in 2008 to $400 million by 2015. Export growth consistently outpaced domestic expansion, suggesting they had found a formula that worked. Shareholders took notice, rewarding the company with higher multiples than competitors more focused on saturated domestic markets. Strategic partnerships accelerated this momentum. Rather than trying to go it alone, TVS formed joint ventures with local manufacturers in Indonesia, Nigeria, and Kenya. These partnerships provided instant market knowledge, regulatory navigation, and distribution capabilities that would have taken years to build independently. On paper, it was textbook international expansion. Perhaps most impressively, TVS did not simply export Indian models and hope for the best. They invested in product adaptation, developing region-specific motorcycles and scooters designed for local road conditions, fuel quality, and consumer preferences. The TVS Star for African markets featured reinforced suspensions for unpaved roads, while Latin American models emphasized styling that appealed to local tastes. This was not about dumping excess inventory. It was thoughtful market development. Industry analysts began featuring TVS in reports about emerging multinationals, comparing their expansion strategy favorably to Japanese manufacturers' moves decades earlier. Management received invitations to speak at business schools about successful globalization from emerging markets. The narrative was compelling. An Indian manufacturer was showing the world how to build a truly global brand from a developing economy. The early success seemed to validate every assumption behind the expansion. Markets were growing, partnerships were working, and profits were flowing. What could possibly go wrong? But TVS faced a problem domestic success could not solve. By the middle of the 2010s, the Indian motorcycle market was showing clear signs of saturation. Two-wheeler penetration had reached levels where growth would inevitably slow. Most households that could afford a motorcycle already owned one. The market was not collapsing, but single-digit growth represented a dramatic slowdown for a company accustomed to expansion. Simultaneously, competitive pressure intensified at home. Hero MotoCorp and Bajaj Auto were not standing still. They were launching aggressive new models, expanding their dealer networks, and squeezing margins through promotional activity. The domestic competitive landscape had never been more challenging, with profitability under pressure despite the strong market position of TVS. This created a growth imperative that could not be ignored. Shareholders and analysts had come to expect continuous expansion from TVS, with stock valuations reflecting those expectations rather than current earnings. Maintaining a premium multiple required demonstrating a clear path to double-digit growth, something the saturated domestic market simply could not provide. Adding to the international appeal was a currency advantage that made exports particularly profitable during this period. The strong Indian rupee in the early 2010s created favorable economics for manufacturing in India and selling abroad. Financial models showed significantly higher margins on international sales compared to domestic ones, making expansion seem not just necessary, but financially prudent. Perhaps most dangerously, TVS management approached this inflection point with supreme confidence. Their domestic track record was nearly flawless. They had successfully navigated regulatory changes, supply chain disruptions, and competitive threats. That record created a sense that their management capabilities would translate seamlessly to international markets, regardless of how different those environments might be. The combination was potent, market pressure demanding growth, financial models showing international profitability, and management confidence at an all-time high. Something had to give, and that something would be risk management discipline. TVS leadership understood the problem. The solution they chose would test whether an Indian manufacturer could build a global empire in the world's most volatile markets. Rather than pursuing gradual expansion into stable markets, TVS made a fateful decision. They would aggressively target high-growth but politically unstable regions, primarily in Africa and Latin America. Countries like Nigeria, Kenya, Ethiopia, Argentina, Venezuela, and Colombia moved to the top of their priority list, markets showing explosive motorcycle demand but characterized by political instability and economic volatility. The scale of commitment was staggering. Between 2015 and 2020, TVS committed approximately $2 billion to international expansion, an amount representing nearly a decade of their cumulative domestic profits. This was not cautious exploration. It was an all-in bet on emerging markets becoming their primary growth engine. The infrastructure investments were particularly ambitious. New manufacturing plants broke ground in Nigeria and Kenya. Assembly operations were established in Argentina. Thousands of branded dealerships opened across 3 continents, complete with service centers, spare parts inventories, and technical training facilities. Local partnerships and joint ventures multiplied, creating complex networks of financial obligations and operational dependencies. Yet for all this ambition, TVS made a fundamental error in currency risk management. Despite operating in countries notorious for monetary instability, they failed to implement adequate hedging strategies. Profits remained fully exposed to exchange rate fluctuations, essentially gambling that local currencies would remain stable against the Indian rupee. Financial officers later admitted they viewed currency hedging as an unnecessary expense that would reduce reported profitability. Even more critically, political risk assessment appeared almost absent from the expansion planning. Countries with histories of coups, civil unrest, and expropriation were evaluated primarily on market growth metrics, with political stability treated as a secondary consideration. When security consultants raised concerns, they were reportedly sidelined as being unnecessarily cautious or failing to understand how business works in these regions. Compounding these strategic errors was relentless timeline pressure. TVS executives were acutely aware that Hero MotoCorp and Bajaj Auto were pursuing similar international ambitions. Being first to market became an obsession, with thorough due diligence often sacrificed to beat competitors to key regions. Manufacturing facilities were constructed at breakneck speeds, sometimes before political risk insurance could be properly secured. The result was a massively expanded international footprint built on fundamentally unstable foundations, exactly the kind of expansion that looks brilliant during stable times and catastrophic when volatility hits. Over the next 3 years, the answer became devastatingly clear. The unraveling began with currency collapses that swept across the markets TVS had targeted with stunning speed. The Nigerian naira lost 60% of its value against major currencies between 2020 and 2023. The Argentine peso dropped a staggering 80% in the same period. The Kenyan shilling plummeted 45%. Even the Brazilian real declined 35% against the Indian rupee. These were not just numbers on a spreadsheet. They were existential threats to the business model of TVS Motor. Motorcycles made with Indian components suddenly cost 2 to 3 times more in local currency. Dealers who had taken loans to build showrooms found themselves underwater, and consumers who might have stretched to afford a TVS motorcycle at previous price points simply disappeared from the market. Then, political chaos accelerated the collapse. Coups or attempted coups took place in 3 of the countries TVS had targeted. Civil unrest swept through others. In multiple locations, emergency protocols were activated to evacuate Indian expatriate staff as security situations deteriorated. Manufacturing facilities that had been showcased in corporate presentations just months earlier were abandoned overnight, with security guards the only remaining employees. The inventory situation became a nightmare scenario. Approximately $500 million worth of motorcycles, either completed units or in process inventory, became effectively unsellable as local purchasing power evaporated. Dealers refused shipments they had previously committed to. Warehouses filled with vehicles that could not be sold at any price that would recover manufacturing costs, let alone generate profit. Partnership failures multiplied these problems. Local dealers who had proudly displayed TVS signage began abandoning the brand as economic conditions made motorcycle sales impossible. Joint venture partners initiated legal proceedings to limit their liability. Banks that had provided financing for dealership networks began calling in loans and seizing collateral. The company was forced into a series of emergency retreats that would have been unimaginable during the expansion phase. Entire manufacturing facilities were written off. Dealer networks that had cost hundreds of millions to establish were abandoned. TVS found itself in the impossible position of trying to maintain brand presence while simultaneously executing the most significant market withdrawal in the company's history. By 2023, the damage was complete and undeniable. The financial devastation was staggering. Approximately $2 billion in write-offs wiped out 5 years of domestic profits, creating the first significant losses in company history. Quarterly financial reports became exercises in explaining asset impairments, inventory write-downs, and emergency restructuring costs. Auditors required extensive documentation to justify keeping the remaining international assets on the balance sheet. The physical abandonment of assets told an even more visceral story. Manufacturing equipment, worth an estimated $800 million, was effectively left behind in evacuated facilities, with security situations making recovery impossible in many locations. Specialized production tools, testing equipment, and assembly lines shipped from India at enormous expense were simply written off as unrecoverable losses. This led to a complete market exit from regions that had been central to the company's growth narrative just years earlier. TVS announced full withdrawal from most African and Latin American markets, ending a decade-long expansion effort that had been the cornerstone of their investor communications. Press releases attempted to frame this as strategic consolidation, but the market understood the reality. This was surrender, not repositioning. Perhaps most damaging was the reputation impact. TVS international credibility was destroyed, making any future expansion attempts significantly more difficult. Potential partners in other regions now viewed the company with skepticism. Even in markets where TVS maintained a presence, their ability to attract quality dealers, secure favorable financing, or negotiate with governments was severely compromised. Shareholders felt the impact directly. The stock price fell approximately 40% as investors lost confidence in management's strategic decision-making. Activist investors began calling for leadership changes, arguing that the expansion debacle represented a fundamental failure of risk management that should have consequences. The board found itself defending decisions that had seemed visionary just a few years earlier. The human cost was equally significant. Thousands of employees, both direct and indirect, lost their jobs as international operations collapsed. Dealers who had invested their life savings in TVS franchises found themselves with worthless investments. Consumers who had purchased TVS motorcycles discovered that warranty support and spare parts had effectively disappeared, stranding them with rapidly depreciating assets. The aftermath was not just about financial losses, it was about trust broken at every level of the business ecosystem. What exactly went wrong? It came down to three critical mistakes. Mistake 1 was fundamentally about market selection. TVS consistently chose growth potential over stability, targeting the most volatile emerging markets without adequate risk assessment. Countries were selected primarily on motorcycle demand growth rates and competitive positioning, with political stability treated as a secondary consideration. This created a portfolio heavily weighted toward high-risk environments, with few stable markets to provide balance during turbulence. The data tells the story clearly. 75% of TVS's international investment went into countries ranked in the bottom quartile of political stability indexes. When investors later questioned this concentration, management pointed to the higher growth rates in these markets, effectively admitting they had consciously traded stability for growth potential. This might have been defensible as a small portion of a diversified international portfolio, but as the core of their expansion strategy, it represented an existential gamble. Mistake 2 was about currency exposure. TVS failed to implement adequate hedging strategies against exchange rate fluctuations, leaving their profits completely vulnerable to currency movements. Financial officers later acknowledged they had viewed currency hedging as an unnecessary expense that would reduce reported profitability during good times. This perspective transformed what should have been manageable risks into company-threatening disasters when currencies collapsed. The numbers are revealing. Competitor Bajaj Auto typically hedged 60 to 80% of their currency exposure in volatile markets, while TVS's hedging rarely exceeded 15%. When the Nigerian naira lost 60% of its value, Bajaj Auto experienced manageable losses, while TVS saw their entire Nigerian operation become financially unviable overnight. What appeared as financial prudence during stable periods became catastrophic when volatility hit. Mistake 3 involved political risk assessment. TVS consistently ignored warning signs of political instability, treating emerging markets as if they had developed market governance and stability. Security consultants' recommendations were frequently overruled in favor of aggressive timelines. Political risk insurance was often deemed too expensive or secured only after significant investments had already been made, leaving assets inadequately protected. Internal communications revealed during shareholder litigation showed a pattern of dismissing political concerns. When security teams recommended delaying a manufacturing investment in a particularly unstable region, executives said the company couldn't afford to wait for perfect conditions and that competitors would capture the market while we waited for stability that might never come. This thinking transformed calculated risks into reckless gambles. What made these mistakes particularly devastating was how they compounded each other. Political instability triggered currency collapses. Currency collapses made inventory unsellable. Unsellable inventory created dealer failures, and dealer failures led to brand abandonment. Each problem amplified the others, creating cascading failures across multiple markets simultaneously. Exactly the kind of systemic risk that prudent international expansion strategies are designed to prevent. Perhaps the root cause was a form of management blindness born from domestic success. TVS's leadership had succeeded brilliantly in India, a market with its own challenges, but one characterized by relative stability, predictable currency movements, and consistent rule of law. This created false confidence about operating in fundamentally different international environments, where the rules of business could change overnight through political decree or currency collapse. Maybe that's the real lesson about international expansion. The first truth is about risk assessment reality. Market opportunity means absolutely nothing without market stability. The potential for selling millions of motorcycles is irrelevant if currency collapses make those sales unprofitable or political chaos makes operations impossible. Growth potential does not justify existential risk, something TVS discovered at devastating cost. This connects directly to the necessity of currency hedging in international operations. When companies expand across borders, particularly into volatile emerging markets, failing to hedge currency exposure is not business strategy. It is gambling. The small reduction in reported profits during stable periods is the insurance premium for surviving the inevitable volatility. TVS paid billions to learn what financial officers should have known from the beginning. There is also a fundamental truth about the political stability premium in international business. Stable markets with lower growth often generate better long-term returns than volatile high-growth markets, simply because they allow consistent operation and predictable financial results. The boring market that grows steadily for a decade ultimately delivers more value than the exciting market that grows explosively for 2 years before collapsing. This points to the wisdom of incremental expansion rather than aggressive land grabs. Successful international growth requires patience, the discipline to enter markets gradually, build capabilities methodically, and expand commitment as understanding deepens. TVS allowed timeline pressure to override prudent risk management, rushing to beat competitors into markets they did not fully understand. The final truth is perhaps the most fundamental. You can chase global dreams and generate massive attention, but at the end of the day, someone still has to buy the motorcycle, and they need stable currency and peaceful streets to do it. Business fundamentals do not change just because markets are emerging or growth rates are exciting. A customer needs purchasing power, product availability, and basic security to complete a transaction. TVS Motor's international collapse was not inevitable. Different market selection, appropriate risk management, and patient expansion could have created a sustainable global footprint. Their domestic expertise and manufacturing excellence provided all the ingredients for international success, except for the risk management discipline that international volatility demands. The company's export dream did not fail because the products were wrong or the brand was weak. It failed because TVS forgot the fundamental lesson of international business. Being a successful global company is not just about capturing opportunity. It is about surviving the inevitable storms that emerge when operating across diverse, unpredictable, and sometimes unstable environments. The motorcycles were ready for the world. The company was not ready for the world's risks. The $2 billion TVS collapse reveals how quickly global ambition crumbles without proper risk management. Currency crashes, political instability, and reckless expansion destroyed what took decades to build. Was pursuing explosive growth worth sacrificing stability? Comment your thoughts below and subscribe. The business landscape is shifting, and you will want to see what collapses next.